South Korea just told Donald Trump no. Not to a handshake, not to a photo op, but to a $350 billion demand that could drain its economy overnight. Imagine being America's closest ally, forced to choose between loyalty and financial collapse. Protesters in Seoul are calling it tribute money. Economists warn it could replay 1997 when the won lost half its value and families melted down jewelry to survive. And this isn't just Korea. Europe is resisting U.S. tariffs, Canada's rejecting energy terms, and allies everywhere are asking the same question. Is America's leverage turning into America's liability? The figure was designed to impress $350 billion in South Korean investment into U.S. projects. Trump presented it as proof his tariffs were forcing allies to pay up. But Bloomberg reported on September 8, 2025, that Seoul's economists saw something else, a forced withdrawal of capital that could gut liquidity and trigger panic. Lee drew the parallel himself. "We know what a sudden outflow looks like. We lived it," he told Reuters in an interview that same week. The memory is raw. In 1997, South Korea's won collapsed from 800 to over 1,700 per dollar within months, according to IMF data. Families sold wedding rings to restore reserves after a $58 billion bailout. Entire conglomerates folded. Lee's warning was not abstract. It was a direct line to lived trauma. And now, with Trump insisting on cash transfers controlled from Washington, Seoul fears history pressing down again. South Korea offered a safeguard, a Federal Reserve swap line. Such agreements, used way back in 2008, allow central banks to exchange currencies to stabilize markets. But Reuters confirmed on September 10th that Washington dismissed the request outright. Commerce Secretary Howard Lutnick argued Japan had accepted similar terms. The comparison rang hollow. Japan holds more than $1.2 trillion in foreign reserves, while Seoul only has $410 billion. Japan enjoys a permanent swap line with the Fed. South Korea does not. The imbalance sharpened Seoul's suspicion. Was Washington negotiating in good faith or just testing how much strain an ally could bear? Trump portrayed the deal as leverage. Yet the Wall Street Journal on September 12th noted South Korean firms feared downgrades to their credit ratings, especially in autos and electronics. For an export-driven economy, that risk was existential. Tensions deepened when U.S. immigration agents raided Hyundai's Georgia battery plant, detaining over 300 South Korean workers. Photos of shackled employees flooded Seoul's media. Trump intervened to resolve the standoff, the Financial Times reported on September 14th, but honestly, the damage lingered. Partnership cannot be built on humiliation, a South Korean lawmaker told reporters. Trust was cracking. Lee's words drew the line sharper. Without safeguards, this demand could destroy our markets. No government can accept such terms. The statement, delivered on September 9th, was the strongest rebuke Seoul had issued toward Washington in years. Yet the standoff widened beyond Korea. Europe was already sparring with Trump over digital taxes on United States tech firms. Brussels faced threats of retaliatory tariffs, but EU Trade Commissioner Valdis Dombrovskis said on September 5th, Europe will not suspend its measures under intimidation. The echo was unmistakable. Like Seoul, Europe weighed economic stability against United States demands and chose resistance. Canada followed a similar path. Trump pressured Ottawa to expand liquefied natural gas exports under shipping rules favoring United States carriers. Prime Minister Mark Carney rejected the proposal as economically distorted, Bloomberg reported on August 29th. Tariff threats on lumber and dairy soon followed. Again, a familiar pattern: allies asked to concede, allies pushing back. These clashes, when viewed together, suggest a structural shift. South Korea's dilemma is unique in scale, but not in kind. Washington's allies are no longer absorbing costs automatically. Neutral analysis requires weighing two hypotheses. Either the United States is strategically extracting resources to shore up its position, or it is overreaching in ways that erode its alliances. South Korea's vulnerability, however, remains the sharpest test. The IMF's July 2025 currency monitor put the dollar's global reserve share at 57%, down from 66% a decade ago. Meanwhile, the renminbi rose to 7%. In that context, Trump's insistence on a $350 billion cash infusion looks less like strategy and more like desperation. Allies can read the same charts. If they conclude the United States is shifting burdens to mask financial strain, credibility erodes. Lee underscored this in his Reuters interview. We cannot destabilize our economy to provide headlines abroad. He added, between blood allies, there must be rationality. The phrase, careful but pointed, was a warning. Military partnership cannot justify economic collapse. Trump, for his part, insists terms are non-negotiable. His calculus is political as much as economic. With midterms ahead, he wants proof tariffs deliver results. A $350 billion deal would serve that narrative. But what if Seoul walks? Then the image of American leverage becomes, well, an image of its limits. The tension with Japan really illustrates the fragility here. Tokyo managed a deal earlier this year, but with stronger reserves and US guarantees that Seoul just doesn't have. To South Korea, that feels less like partnership and more like hierarchy. And, hierarchies breed resentment. The European case shows similar dynamics. Brussels, backed by its market size, can resist. Canada, tied by geography, still pushes back. But Seoul, with fewer cards, is forced into a much starker dilemma. That asymmetry risks creating a perception, not of unity, but of selective exploitation. Meanwhile, North Korea looms. With 28,500 US troops on the peninsula, security ties remain vital. Yet, Lee stressed that tying defense to destabilizing trade terms would totally backfire. The Financial Times quoted him on September 15th. "Security and commerce cannot be confused. We must separate them." That separation may protect military cooperation in the short run, but it really underscores how trade is becoming the flashpoint. Protests in Seoul have, really amplified the pressure. Outside the National Assembly, demonstrators compared Washington's demands to colonial tribute. Polling by Gallup Korea on September 9th showed 61% opposed to the deal as written. For Lee, the domestic cost of acquiescence is rising. For Trump, backing down risks appearing weak. But South Korea is not the only ally calculating risks in silence. Australia has quietly adjusted its currency reserves, raising the share held in Chinese renminbi to 25%, according to the Reserve Bank of Australia's July 2025 report. Officials describe the move as diversification, yet it reflects the same anxiety Seoul expressed. Reliance on Washington has become less predictable. Canberra is still aligned militarily with the United States, but financially it is hedging elsewhere. The ripple effect extends to corporate boardrooms. Bloomberg reported on September 3rd that European car makers, wary of tariffs on exports to the United States, are redirecting investment toward Southeast Asia. Volkswagen and Stellantis both announced joint ventures in Thailand and Indonesia to shield themselves from political whiplash in Washington. This shift is not just about taxes. It signals that multinational firms are building supply chains designed to bypass the United States altogether. Financial markets are drawing their own conclusions. The Wall Street Journal noted on September 16th that United States Treasury auctions have struggled to attract foreign buyers at previous levels. Bid-to-cover ratios, a measure of demand, fell below 2.0 for the first time in 3 years. Analysts pointed out that if allies like South Korea and Japan are unwilling to expand commitments, and if China is trimming its holdings, the United States may be forced to lean more heavily on domestic buyers. That pushes yields higher, tightening financial conditions at home. At the same time, Asian regional institutions are stepping in where Washington is stepping back. The Chiang Mai Initiative, a multilateral currency swap network linking China, Japan, South Korea, and ASEAN nations, expanded its available credit to $480 billion in August. The Financial Times framed it as Asia's insurance policy against dollar liquidity shocks. For Seoul, the initiative offers an alternative buffer if Washington refuses a swap line, but its existence underscores a broader point. The safety nets allies once expected from the United States are being built elsewhere. Domestic politics add another layer of unpredictability. South Korea's National Assembly is sharply divided, with opposition lawmakers calling Trump's demand, economic blackmail. Canadian parliamentarians frame tariff threats as an attack on sovereignty. And in Brussels, members of the European Parliament openly debated retaliatory measures against U.S. agricultural exports. These responses aren't marginal. In fact, they represent the mainstream of political discourse in countries that, for decades, pretty much automatically aligned with Washington. Yet Trump's calculus remains focused on optics. In speeches this month, he insisted that resistance proves the deal's magnitude. If it wasn't historic, they wouldn't fight it, he told supporters. But neutrality demands scrutiny. Is this framing resilience, or is it maybe just spin-masking vulnerability? If every ally resists, then the definition of historic shifts from triumph to isolation. Even U.S. businesses are beginning to express concern. Reuters reported on September 12th that the U.S. Chamber of Commerce warned against alienating partners through unilateral demands. Manufacturing groups highlighted risks to supply chains if Korean or European firms redirect capital elsewhere. These are not ideological objections. Honestly, they are bottom-line calculations. The stakes stretch beyond economics. The Indo-Pacific is the stage of great power rivalry, where alliances are supposed to project stability against China and Russia. But if trade deals fracture under the weight of Washington's terms, then the military alliances risk being perceived as transactional too. That perception alone could embolden Beijing and Moscow, who portray U.S. partnerships as coercive rather than cooperative. And so the question sharpens further. How long can credibility survive if allies conclude the costs of partnership outweigh the benefits? The clock is ticking. Parliament is set to adjourn by month's end. Without revisions, the deal will collapse. Trump may call it negotiating theater, but, markets respond to outcomes, not postures. If $350 billion evaporates, so does the claim of historic success. The lessons of 1997 hover over every step. Back then, South Koreans lined up to donate gold jewelry to save their country from collapse. This time, the sacrifice demanded is not theirs but Washington's credibility. For if America cannot persuade its closest allies to risk stability in its name, then what does that say to rivals watching closely? And that is where the crisis cuts deepest. Allies are no longer automatic. Demands, once tolerated, now carry political costs leaders cannot ignore. A deal meant to display strength has instead exposed fragility. If South Korea walks away, and Europe and Canada hold firm, then history may remember not a $350 billion victory, but the moment when allies quietly decided the price of partnership had become too high. We're glad you're enjoying this video. Please like and subscribe. Also, check out another video that is now on your screen.